Hello, everyone. My name is Fazan Ahmed, and I welcome you to another edition of HBL Market Insight. A lot has happened since we last discussed monetary policy. Inflation, when gauged by using CPI as a proxy, crossed 9% in October. For the same month, current account deficit widened to a 3-year high of $1.7 billion. PKR continued to depreciate against USD, as depicted by its most recent close north of 175. All of this transpired into the State Bank of Pakistan's latest monetary policy decision, a decisive increase of 150 basis points, which now takes the policy rate to 8.75%. The Monetary Policy Committee clearly acknowledged the heightened risks related to inflation and balance of payment. At the same time, reinforced that the outlook for economic growth has improved. While the State Bank of Pakistan has not changed its broader macroeconomic projections with regards to the real sector, it has placed special emphasis on the threats being posed by the increase in global commodity prices and the upward adjustment in the administered prices of energy on the inflation projection of 7 to 9% for the current fiscal year. This is not to say that the market was caught off guard. Participation in the fortnightly, T-bill, and the monthly PIB auctions clearly communicated what the market was thinking. Secondary market yields were already 100 to 150 basis points higher when compared against the last monetary policy. If we look at the belly and the long run of the curve in isolation, the surge seems more pronounced. To discuss the specifics with me, I have Risha Muhyiddin, who is the Global Treasurer at HBL. Risha, what are your thoughts on the matter?
Thank you, Fazan. So in addition to the MPC statement, which was quite clear on the backdrop to the rate hike, we got some insight from the governor's briefing at the analyst call that was held on Friday evening. So clearly the 150 points hike was a surprise to the market. Interestingly, the governor did indicate that the MPC wanted to move by an amount slightly higher than the market expected. Now, why would he want to do that? Well, first of all, yields, as Fazan said, had already moved up by 125 to 150 basis points since the last MPC. So in a way, this was sort of catching up to the market as it stands. Secondly, demand has picked up in recent months. Now, if you look back to the MPC statements and the forward guidance provided by the State Bank earlier this year, they did mention that demand had not picked up, that most of the inflation surges they were seeing were due to supply shocks. Now, clearly, in the past few months, demand has picked up. As an indication, we saw in the first 4 months of this current fiscal year, a current account deficit of $5.1 billion. Versus a surplus same time last year of $1.3 billion. So that demand has really kicked into extra imports, and we're seeing that across the board in terms of petroleum consumption, even with higher prices, and auto imports and so on, and many other factors as well. There was a sense building in the market that the SBP was perhaps behind the curve in terms of tackling inflation expectations. Now, this is not something that the SBP governor mentioned, but it is something that people in the market felt. Now, by making this big move, what the State Bank has indicated to the market that it's going to be bold, it's going to be proactive, and it's not going to let inflation expectations derail the economic recovery. Now, the governor referred to other central banks around the world and the difficulties they're facing. For example, the Federal Reserve now for months has been stating that inflation is transitory and it should start coming down. But it's shown stubborn signs of remaining high. In fact, the last reading in October was 6.2%, which was a 30-year high for CPI in the US. At the same time, their own models show that demand is starting to ease from the second quarter next year onward. So what you might have there is stagflation, which if you were around in the 70s, you would recall that it was a term used to describe low growth and high inflation at the same time. So in those circumstances, what does the central bank do? It's a very difficult choice for them. And it just really demonstrates how blunt a tool the interest rate policy is when you're faced with such large headwinds. And these have to be supported and buttressed by fiscal policy as well as administrative measures. Now, coming back to Pakistan, so where do we go from here? Now, the governor was at pains to point out that he doesn't see rates going back to 13%, which was the high in the last rate hike cycle before the pandemic hit. At the same time, we do feel now that they are going to be very wary of further build-up in inflation expectations. Now, what we do feel is that given the fairly strong measures that have been taken, firstly, the hike in the CRR, the cash reserve requirement, where Basically, it sucked out about 160 to 170 billion of liquidity from the market. Secondly, in terms of the rate hike itself, which should have an effect on demand. So we do feel that going forward, the State Bank will look at the data carefully and then decide where to go. It's by no means a certainty that we will see another hike in the next MPC. As I said, they'll look at the data coming through and then decide on balance which way to go. So with that, I leave you. Wish you all the best and good luck going forward. Thank you.